Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today what we're going to be talking to you guys about is how you can lower the interest rates on your policy loan and also add a level of convenience for taking loans for multiple policies.
Yeah, I would tell you, I've been using this strategy for, 6 to 9 months now. Typically what we like to do is before we recommend something to our listeners or our clients, we want to try it first.
Mm-hmm.
So we've been using this. I've been really enjoying this. The easy access, not only am I lowering the interest rate, access to the funds are easier. And particularly when you have a lot of policies, it adds a little bit of layer of complexity, but this does make it much more efficient.
Mm-hmm. So before we get into them, what we're going to be touching on is kind of the LELOC, right? We've referenced this in podcasts previously, but we're going to be talking about it. And today what we're going to do is we're going to touch on 6 advantages of using it and also potentially 2 disadvantages of using it.
Cameron, what does the LELOC stand for?
Life Equity Line of Credit.
Yeah, and it's kind of like we've all heard of a HELOC,
Mm-hmm.
home equity line of credit. We're calling this a LELOC, life equity line of credit. Very similar. We're just using a different asset.
Mm-hmm.
Instead of using the equity of your home, we're using the equity in your policy.
Speaking of similar but different is, I think before we move forward, let's remind the listeners, and I'll remind you, of how policy loans actually work, Anthony.
Okay.
Is a
Fill me in.
common misconception in infinite banking when somebody hears about it is that we're taking money out of our policy. And that, again, is not the case. What we're doing is we're building up cash value in our policy, and we're approaching the insurance company, and we're using the cash value in our policy as a collateral, and we're taking a loan from the general fund to the insurance company. And so we've got to make that differentiation and remind you guys before we move forward. And Anthony, if you want to explain to them what we're doing with the line of credit, where's the loan coming from in that case?
Using the LELOC, very similar process. We're just replacing one character of the play. Instead of borrowing from the insurance company and they use your policy as collateral, we work with a couple banks that we do the same thing. We borrow from the bank and they use your policy as collateral. So really with mechanics, it's very simple.
Yeah, very simple. And what I would say is that anytime you change something, right, it's like I've heard you say this a lot because you reference accounting, and I don't know if the listeners know, but you're a recovering CPA.
Oh, thanks for sharing.
Exactly. Anytime you change something, in this scenario, we're going to be changing it from our loans from the insurance company to a bank, is there's always a give and take, right? Very similar to accounting. So we do have some advantages by moving and switching and using to a bank. We also have some disadvantages. So Anthony, let's start with the advantages.
Perfect. Biggest advantage is going to be a lower interest rate.
Okay. And when you say lower, can you give us some ballpark numbers here?
Right now, depending on the amount of cash value you have, like with almost any loan, the larger the loan, the lower the interest rate.
Mm-hmm.
Now, the loans can be as low as 3%, right? But or up to 4%.
Okay.
So, kind of, if you're listening, I would use somewhere in the middle. So let's just say 3.5.
Okay.
Right. But here's one thing I want to make clear is this is not affecting the policy, because I know some of my clients that are using it are worried about the interest getting paid back. Are they following becoming your own banker? We're following everything that is in the book. The only difference is we're borrowing from a bank instead of the insurance company. So this doesn't affect really anything you're doing, except the cost of money is going to be a little bit less.
Huge advantage there, right? And like Anthony said, the more that you borrow, the less that interest rate will be. The second advantage that I've seen is actually just a level of convenience, right? Anthony and I have been doing this infinite banking strategy for a while. We have multiple policies, and many of our clients do too. And I don't know if you remember going back when we used to have to borrow for multiple policies and even sometimes multiple insurance companies.
Mm-hmm.
That got to be a huge headache, right? And so if we are able to use this bank, we can actually consolidate, accumulate all of our cash values or aggregate all the cash values in multiple policies with multiple insurance companies with one bank, and they're giving us one direct line of credit, which is much more convenient.
Yeah, sometimes there's been a couple times where I didn't have enough money in one policy.
Mm-hmm.
So then I had to make that decision. Okay, list my policies. Where do I take the money from?
Yeah.
But then also you have that same exercise when you're going to pay it back.
Mm-hmm.
Right now I'm going to pay it back. And how much do I put into each policy? This just makes it super simple.
Absolutely. So let's move on to the third topic. Is a third advantage that we've highlighted is going to be checkbook access. Anthony, can you highlight for the listeners what actually happens? You just kind of touched on it there. They do take a loan, and what does that look like when they're utilizing that line of credit?
They're going to give you checkbook access, which means when you need the money, you can simply write yourself a check.
Mm-hmm.
I know we're flipping land, and we needed some more capital in there. So instead of talking to Becky and getting a policy loan and having my wife sign it and I sign it, I just simply wrote a check, and it was in there.
Nice.
Right?
Yep.
And you also have the ability to do a wire, which will shorten that period where you could have the money in there the next day. The wire is going to be a cost,
mm-hmm.
but if you don't mind waiting, writing a check is pretty simple, especially now. You don't even need to go to the bank.
Yeah.
You can take a picture of the check on your phone and deposit it.
Yeah. Awesome. Number 4, Anthony. What?
Number 4, if you've noticed, if you're banking and using policy loans and try to go to the insurance company and see what your cash value is or the loan, the user face. These are life insurance companies.
Yeah.
Okay. So they're very conservative, right? And most of their policy owners aren't using it like we are, right? Their main thing is, what's my death benefit, right? When's my premium due?
Yeah.
Right. But we want a little bit more detail. How much cash can I have? What is the loan balance?
Mm-hmm.
But in some of these insurance companies, their user interface online is like from the 90s.
It's bad.
Sometimes I log in and I'm waiting to hear that
the dial up.
that dial up. But here, it's a bank.
Mm-hmm.
I mean, so the banks are more in tune with the latest technology. In fact, I have 2 LELOCs, and in part because I wanted to try out 2 different banks, but one of them I have an app on my phone. So if I want to see what my cash value is, or if I want to see what my loan balance is, I can do that from my phone. And I will say that to get my cash value, I'm going to have to go to the insurance company.
Yeah.
Right. But to find that loan or that loan balance, I can find that very easily on my phone.
Mm-hmm. Awesome. 5th advantage, right, is the ability to deduct the interest.
Well, I'd clarify, it makes it cleaner to deduct the interest.
True.
Because now, just to recap, if you use a policy loan for an investment purpose, really, I think if you use it to generate taxable income, like loan it to your business, buy a rental property, or buy an asset that's going to be taxable, then the interest you pay for use of those funds is also going to be taxable. And it's very similar to margin interest. If you have an investment account where you can borrow against your investments and buy more stocks on margin or as interest, same exact process, right? But what makes it complicated is on the rare chance that you are audited, again, the burden of proof is on you. And if you go and show them your statement from the insurance company, particularly at the beginning, the agent at the first level who's actually in there doing the digging doesn't really know much. Okay, I'm just going to be blunt. But we're going to have to educate them. All right, this is why. And we have the white papers and we can substantiate it. But who really wants to go through that?
Yeah.
By having it through a LELOC or for a bank, that's going to raise much less questions, because it's just like any other bank or any other loan that you do have. So it's going to make the deductibility much easier to track and also to support to the IRS.
Well said. Yeah. Awesome. Advantage number 6, Anthony, is direct recognition is not non-direct.
Correct.
Yeah.
I think I might have did a typo when I was typing that out, but I am a recovering CPA, right? And again, we're getting a little technical with the way insurance companies allocate dividends. Now, some of them, it's called non-direct, meaning whether you're going to get the same dividend whether you have a policy loan or not.
Mm-hmm.
Okay, but there's other companies that they're called direct recognition, meaning if you have a loan, you may get a lower dividend on the part that you have loaned out. Okay, but I will say those companies typically pay a higher dividend. So when we've done the math comparing a direct and non-direct, the direct recognition has higher dividends. And when we account for max policy loans, meaning we're taking a max loan every single year, so then that way we can account for the lower dividends, and the cash value is similar or very equal to what the non-direct recognition companies are. So that's why in our view, we're not overly concerned about whether they're direct or non-direct. However, by using the LELOC, technically, you don't have a policy loan,
mm-hmm.
right? You have a loan from the bank. So that allows you to get the full dividends, whether you have a policy loan or not. So then at that point, it doesn't matter if the company's direct or non-direct.
Yeah, well said. Awesome. Real quick, I want to kind of review the 6 that we just covered, mm-hmm. right? And then we'll jump into 2 of the disadvantages. The first advantage that we've got by using that LELOC, number 1, is we're going to get a lower interest rate. Mm-hmm. Number 2 is a matter of convenience, right? If we have multiple policies, we can consolidate all those cash values and or multiple companies with one line. Mm-hmm. 3, they're going to provide us checkbook access. 4 is we've got a much better user interface. 5, it's going to be much easier to deduct the interest on any sort of policy loans. And then number 6 is it doesn't have an impact on direct recognition companies if we have our policies with them. Awesome. Anthony, let's jump into the 2 disadvantages that we can think of. What's the first one?
I will say that when they first process a loan, they're going to do a soft credit check.
Okay.
And you just got to be aware of that. Mm-hmm. Particularly if you're in the process of getting a mortgage or buying investment property, you want to be careful not to add anything else on your credit. But those soft credits have a much smaller impact than they do on a hard inquiry.
Mm-hmm. Well said. And second disadvantage that you can think of?
Well, the interest is, depending on which bank you use, interest is going to be due monthly or quarterly. Mm-hmm. Like when we use a policy loan, it's due on your anniversary. But here's the cool thing. Just like when you get a policy loan, if you don't want to pay it, you don't have to. They're added to the loan. But with a LELOC, even though interest is due monthly or quarterly, you still have the ability to add it to the loan. But I will say personally, I found it more convenient to pay my interest monthly. Mm. And in part, just cash flow wise, it's just easier to pay a little bit each month than to pay, a lump sum every 12.
Yeah. I just thought of a third disadvantage.
Well, I thought of a fourth one.
Oh, okay.
Go ahead.
Yeah. Third disadvantage that I thought of was there's actually some insurance companies that we've written with in the past that LELOCs don't work for. right? So some of those companies, some of those banks will not loan against certain types of companies or certain insurance companies. So if you guys have a question, feel free to reach out and we'll get you that list.
I did one thing to know is that the interest on the LELOC is variable. Okay. Now, at some point, I'm sure everybody's listening is anticipating interest rates going up.
Yeah.
Right. Now, here's the thing. Let's say right now, interest rates are much lower than policy loans. Now, interest rates are going to rise. Now, the interest rates on a LELOC are going to rise. I think they're going to increase or decrease more frequently than a policy loan. And it's possible that the LELOC interest could be higher than the interest on the policy loan. But what I would say, even if it's a little bit higher, I'd still want to use a LELOC because of the advantages of the simplicity and the convenience. Yeah. But let's say the LELOC gets real high and I don't want to, I'd rather use a policy loan, or maybe I don't like using the LELOC. I just want to go back to the policy loan. You can do that super quick.
Mm-hmm.
You just take a policy loan and pay off the LELOC and close it.
Well said. So let's review these 4 disadvantages before we wrap this thing up. Number 1, what we talked about was a soft credit check.
Mm-hmm.
There will be an inquiry when you start this process. Number 2 is that the interest is due monthly and or quarterly, depending on which bank we're going to be using. Third topic that we touched on was some insurance companies, banks will not lend to some insurance companies on that LELOC. And then also the interest rates from the banks on the LELOC are variable as well. So 4 disadvantages. We came up with 2 of them just here at the end. But
now we're going to have more information on our online course.
Mm-hmm.
And in there, we're going to have contact information of the banks, the different interest rates, and some of the pros and cons of each of those as well.
And we'll highlight some of the thresholds, right? Is those amounts that you borrow do have an impact on the interest rate. So we'll highlight those as well.
And so if you're interested in a LELOC, or maybe you're finally figuring maybe I want to learn more about this infinite banking deal, schedule a discovery call with us, about 15 to 30 minutes, discuss your goals and kind of see if infinite banking is for you. And if it is, then we're kind of pointing in the right direction on how you can learn more about it.
Awesome.
Go make it a fantastic day.
Take care.